Do you own investment property in California? If so, it might make sense to consider a 1031 exchange into an out of state property or properties. Besides the obvious benefit of deferred capital gains tax, there are three other major advantages to having your real estate investment capital leaving this state. Benefit 1: Cash flow. First, a necessary definition. Cap rate, short for capitalization rate, is simply the net operating income of a property divided by the purchase price. Another way to think of cap rate is the annual yield a property will generate if purchased for all cash. So, if you have a real estate asset worth $10 million and you buy at a 4 cap with all cash, you should expect $400,000 of net operating income, which would equal your annual net cash flow, assuming there were no capital expenditures and no financing costs. Loan amount and loan payments are not taken into account for this metric, so that we can more readily compare one property's performance to another. In the next slide, we will review the difference between cap rate and cash on equity return, and how financial leverage can significantly impact the latter. According to 2020 CoStar data, out of 392 apartment markets across the United States, 8 of the lowest 10 cap rates, meaning lowest cash yields, are in the state of California. And the lowest cap rate in the country is San Francisco, with other Bay Area locations following closely behind in spots 2 and 3. So, what does a 3.6% cap rate mean in terms of annual cash flow? In this example, we compare San Francisco's 3.6% cap average with both a 5% cap and a 6.5% cap opportunity in a different metro market. Let's assume we have the option to buy a $10 million property with 40% down in all three scenarios. The only difference between properties is the cap rate. As you can clearly see in this table, after you make the debt service payments on your $6 million loan, San Francisco generates negative cash flow. In fact, you'd have to take $20,000 out of your own pocket each and every year to not default on the loan. Contrast this with the 5 cap property, which would net you $120,000 per year in pre-tax cash flows, excluding capital expenditures. At a 6.5 cap, the annual cash flow soars to $270,000. To state another way, your $4 million down payment would generate a negative 0.5% annual cash loss on your money in San Francisco. This return would turn slightly positive and yield a 3% cash flow for a 5% cap rate property, and would increase dramatically to a 6.7% cash yield for the property with a 6.5% cap rate. Now, part of this negative cash flow in San Francisco does relate to paydown of the loan amount. So despite the negative cash flow, your equity in the property is increasing, assuming flat or positive appreciation. Of course, this is equally true for the other properties as well, and they generate positive cash returns to you rather than require that you feed them. There is a very important relationship to understand when evaluating investment properties from a cash flow perspective, and that is to compare the property cap rate with the debt constant, debt payments over loan amount. Whenever the cap rate is below your debt constant, your cash flow will be negatively impacted for every dollar borrowed. Let's focus on the San Francisco property to illustrate this point. If purchased for all cash, you would earn $360,000 per year, based upon its 3.6% cap rate. 3.6% times 10 million equals 360,000. But since we borrow $6 million at a debt constant of 6.3%, much higher than a 3.6% cap rate, this negative spread drives our cash flow down to a negative $20,000, which represents a cash on equity loss of 0.5%, and this presumes a conservative 60% LTV. Had we run it at 70%, the cash on equity would be an even more severe loss of negative 2.4%. Fortunately, the converse is also true, and this is such a powerful point. Whenever the cap rate is higher than your debt constant, your positive cash flow will be amplified by every dollar borrowed. Let's look again at the 6.5% column to illustrate this dynamic. If this $10 million property were bought for all cash, it would generate $650,000 cash flow per year, consistent with its 6.5% cap rate. But if we instead borrow $6 million, reducing our cash investment to $4 million, we generate $270,000 cash flow, which represents a 6.7% cash on equity return. $270,000 divided by $4 million cash investment equals 6.7%. Note that this 6.7% cash return is higher than the 6.5% return we would have earned had we invested all cash. Had we run this at 70% leverage rather than 60%, your cash on equity return would further increase to 6.9%. This dynamic illustrates the importance of leverage and its impact on your cash return. Knowing what the property generates on its own, the cap rate, versus your cost to borrow funds, the debt constant, is a critical first step when evaluating property acquisitions. The simple reality today is that if you're looking for cash flow, it is easier to find suitable higher cash flow producing, higher cap rate properties in certain strong metro markets outside of California than it is to find them within. And because of this truth, it is also easier to financially leverage your real estate investments outside of California, because generally you don't have to sacrifice cash flow to do so. Moving to benefit number 2, diversification. Let's stick with our previous example and assume you own an apartment building in San Francisco with a market value of $10 million. You were debating selling the property to generate more cash flow. You also like the idea of mitigating your risk through diversification by asset class and location. You are in luck. You can diversify with a 1031 exchange and not pay any capital gains tax to do so. For example, if you performed a 1031 exchange out of this San Francisco investment, you can invest in 3 different markets and asset classes. In this case, a $3 million retail building in Salt Lake City, a $4 million office complex in Colorado, and a $5 million multifamily offering in Dallas. If you are trying to diversify, ensure you are receiving guidance from a qualified 1031 professional that can implement the correct 45-day identification strategy. Benefit number 3, you can leave behind California's laws that increasingly hurt real estate investors. Existing California laws and regulations aren't landlord-friendly, and they are getting worse with each passing year. 2 recent examples are California Assembly Bill 1482 and Prop 13 reform. AB 1482 is the statewide rent control law that passed in October of 2019. Prop 13 reform might be coming in the next few years. This reform would likely increase property tax expense and thereby further cut into California investors' cash flow. Assembly Bill 1482, the statewide rent control law. First off, how common are these laws? Well, there are only 2 states in the US that currently implement statewide rent control: California and Oregon. Under AB 1482, rent increases are capped at 5% per year plus an inflation index. The total rent increase is capped at 10% per year, which would pose a major issue during a period of significant inflation. This part of the law will harm real estate investors, but the just cause tenant eviction is likely an even larger concern. Under the previous law, if an investor was planning on selling a property, they could give a tenant 60 days notice to move. This would allow the owner to make repairs and move the potential rent close to the market value before selling. Now, under AB 1482, owners will have to pay their tenants 1 month rent to move out, unless they violated their rental agreement. This payment could be large and make an already negative cash flow even worse. Prop 13 reform. What was the original Prop 13? This proposition was approved by California voters back in 1978. It greatly limited property taxes during a period of significant real estate appreciation. The law stated that the tax assessed value on all real estate could only increase by 2% per year until sold. Once sold, the property would be reassessed for tax purposes. When the law was written, it applied to all commercial and residential buildings. The proposed new reform is called split roll. Under the reform law, Prop 13 protections would remain the same, except many commercial and investment buildings with a market value greater than $3 million would be reassessed every 3 years, not just when sold. If Prop 13 were to pass, your annual operating expenses could increase dramatically upon reassessment, while your top-line rental income remains relatively flat given the constraints noted in the previous slide. Here's an example of how Prop 13 reform could significantly affect your property taxes. Let's assume you purchased a San Francisco apartment building for $5 million back in 2000, and you still own it today. If we use San Francisco market data, that same property is likely worth north of $16 million in 2020. However, because you never sold the property, the assessed value was limited to a 2% annual increase, which is about $7.4 million in 2020. So you are paying about 1% property taxes based upon a $7.4 million value, instead of a value closer to $16 million. If the Prop 13 split roll reform passes, the assessed value on this property would increase by this difference. In this case, that difference would be $9 million. Multiply this $9 million increase by a 1% tax rate, and the result is an annual $90,000 hit to your property cash flow each and every year. To summarize, the three major benefits to performing a 1031 exchange out of California are: number one, opportunity for better cash flow; number two, greater diversification; and number three, you can move your investment to a more landlord friendly political and legal environment. Thank you for watching the video. If you have any questions, please use the comments section below. If you are a real estate investor in need of 1031 exchange guidance, we'd like to help. We've assisted hundreds of 1031 exchange clients over the past 33 years. Feel free to email info@gerardore.com or call 415-599-4900. Thanks again for watching.